Hello Ramesh, welcome to Bahrain.
Thank you, Vinit. Lovely to be with you.
So how you are feeling Bahrain?
Lovely. I just enjoyed when I landed at the airport in the morning. Beautiful, spanky new airport. We drove to the city.
Correct.
Seemed like a Dubai without the fuss, and had a great breakfast thanks to you. So I'm really enjoying my short but meaningful stay here.
That's why you are Ramesh Damani. You have said it correctly. Dubai without fuss. That is Bahrain. So thank you for being on this show.
Sure.
Let me tell my viewers that this particular podcast, Mr. Damani has obliged us with this amazing podcast on our theme, Future Ready. When we talk about Future Ready, I think I should start with first thing, our generation from Kashmir to Kanyakumari, everyone has seen you over TV talking about stock market with great clarity and wisdom. I want to start with the starting. What is your upbringing, where you were born, so we get an idea of how you were actually your early life?
Sure. Thank you so much, Vinit. I was born in India in South Bombay. Actually, I was born in Hyderabad.
Okay,
But we moved
Hyderabad?
Hyderabad.
I thought you were in Bombay.
Yeah, but we moved very early on to Bombay, so I consider myself a Bombayite. And in fact, even today, I stay in the house my father purchased when we were younger. So we grew up in South Bombay, went to college, school in South Bombay. Then for a brief period of time between, say, 1977 and 89, I went and studied overseas, did my MBA, worked out there.
Okay.
Then 89, I came back and became a member of the Bombay Stock Exchange, as you know. So broadly, most of my kid life and the adult life have been Bombay, except for a period of 10 years where I studied in America.
So going back, I think so, about your education. So what did you study during your undergraduation and in your US? What was this transition? I think in those days, going to US was not a first option for many.
It was an emerging option. In 77, still I was one of the first few Indians to reach out there. I went to Los Angeles, which is basically the center of Hollywood. So, you have to have interest in entertainment, in the movie industry, whatever. But somehow, the thing I always remember about LA is that when I first went to LA, I stayed with my sister, Chandra. And she asked me what I wanted to see, and typically the answer would be, I want to go to Hollywood, I want to go to Disneyland, I want to go to the beaches, which LA is famous for. And I remember telling her, even at that young age, that I wanted to go and see See's Candy Store or a Walmart, which are very unknown even at those times. That's because of my influence by Warren Buffett. So even when I was 20 years old, subconsciously at least, Buffett was influencing me. So my sister looked at me very surprisingly, why I want to go there. But being a good sister, she took me there. So I remember seeing See's Candy in 1977 or Walmart in 1977. And they, of course, didn't understand the stock market implications of that. But I just wanted to see it because I'd read about it in Warren Buffett's books.
As you said, See's Candy, and this is written Warren Buffett a lot that this was one of his famous investment, including Coca-Cola, which he invested very early.
Correct.
But when you were actually already influenced so much by Warren Buffett, you didn't think of New York or Wall Street and then went to Hollywood?
No, I mean, I just happened to get an admission there to the university out there. But here's the interesting point I want to share with your viewers. When I went to America, I checked back after I had reached some level of maturity. The price of Berkshire Hathaway stock in 77 was about $75 a share. So I could have bought 1,000 shares for $75 or $75,000 at that time. Had I done nothing next for the next 50 years, suppose I'd gone to the beach, played the casino or the roulette wheel in Las Vegas, or traveled or done anything else, that same 1,000 shares today would have been worth $750 million US. 1,000 shares became from $75,000 to $750 million. That has compounded over a 50-year period about 20%. That is what Buffett taught us. The long-term compounding is what makes a difference, what makes wealth. Of course, I didn't do it. I wish I'd done it. But it just felt nice that to go back and understand those lessons that were so formative in my early years and understand what a difference it makes, long-term investing, staying the course, being patient. I think we all learned that from Buffett.
Yes, so that's tend to bring me to first question. What was your first accident with equity market? What was your first investment?
The interesting story again, I think I was one of the first few techies out of India. So in 77, I was working in technology business, not particularly interested in the stock market, very interested in reading. So I used to read quite extensively, even at that time. But my father, who was in the stock market in India, smallest stock market in India at that time, was quite keen that I understand the stock market. So as I famously said, he made a wager with me that he would send me some money, and if I made money out of it, it was mine to keep. If I lost it, no questions asked. Seemed like a pretty fair deal to me. So I started investing in the US stock market, and as I've said it many times, that in the beginning of a bull market in America, 1980s, 82, when the bull market Dow was at 1,000, today it's closer to 50,000, I managed to lose it all within 6-8 months. And that taught me a lesson, as much important as Buffett taught the long-term investing. It also taught me another lesson, that when you drive, you look at the front view mirror, not the rear view mirror. What I was doing, the mistake I was making was driving, looking at the rear view mirror. What worked in the 70s in America, the inflation-ridden oil stocks, gold stocks, silver stocks, they'd fallen 60-70%. So in my naivety, I thought, how much further can they fall? They've already fallen 60%, 70%. Correct. They could fall 90% from those levels also, as I realized. So I bought those stocks, I lost money. But I learned a very inexpensive lesson. The amount of money that my father sent, I learned a lesson that when you're in equity markets, you look ahead, not look back. And so I think long-term investing, looking ahead, all lessons I learned fairly young in my life.
So this brings to the most important question which people look to, how to look ahead.
Yeah, I think the equity market is also a full-time profession. So you want to look at how the world will be in the next 10, 20 years. For example, and I say this again in the presentation I'll make tomorrow, is that we tend to live our life, every day looking ahead, but we understand it backwards. Okay?
Correct, yes.
We understand what happened backwards. Yeah. So I came of age, I call myself one of the gilded generation in India, because we came of age in the late 80s when we graduated from school, college, got our feet wet, understood what happened. And I went back to India in 87, 88. But look what happened in the next few years. In 89, the Berlin Wall fell. It was an enormously momentous decision. And I'll explain some of that in the Kuwait, in the Bahrain conference that we'll be doing. In 92, India started liberalizing. As a direct consequence of the Berlin Wall falling and the Soviet system being beaten, India had to change in order to survive. In 95, India became a tech superpower. So we had an enormous amount of tailwinds as we went to investing. As I never get tired of saying, Vinit, that when I went, the index was 800. Today it's closer to 85,000. So it's been a fabulous run. But to come back to your original point, how do we look ahead? I think when Donald Trump got elected on November 5th, 2024, the world again changed. The world from the gilded generation, the globalization, internationalization, liberalization world changed. And we're now in a whole new world. So I think the next 20, 30 years we'll have to deal with more inward-looking economies, more self-sufficient reliance, more importance in domestic economies. Artificial intelligence will be obviously a big part of whatever our lives are in many ways. But I think the world that we enjoyed for the next 30 years will probably have changed and changed significantly for investors. And it is the job of investors to figure out what those changes will be and how to profit from it. I think there was an ice hockey player called Wayne Gretzky. He's very famous for ice hockey, which is not a very popular sport in
Yes, a Canadian guy.
Yeah, in Canadian player. And he always used to say this statement which made a mark with me. He says, he was always taught not to go where the puck was, but to go where the puck was going to be. So I think that as investors, we need to remember that lesson. We need to invest where we think the world economy is going to be 5, 10, 20 years. Not just because it's convenient for us to think of where it should be, but where it's going to be. So I always try to keep that in mind.
Like a lot of, I'm a young chartered accountant. We want to know how to train ourselves for how to look ahead, because this becomes a very important skill. So how did you learn to look ahead?
I think I also had great mentors. I need to mention that, I stood on the shoulders of giants. I think it helped that first I read a lot. I think it really helps to read a lot. And not necessarily about a balance sheet or an analyst report. That's, just part of the course. But just a broad reading, a good liberal education, broad understanding, biographies, newspapers, editorials, self-help books. They're all extremely important to read, because you develop then a worldview, and then you kind of start thinking things through, understanding the valuation. See, here's what helped me and what can help younger people. Warren Buffett explained this concept very clearly. He called it the Mr. Market concept. He says every day the market to use a cricket analogy, throws a ball at you.
Correct.
It tell you Reliance at 2,000 rupees, Infosys at 1,500 rupees, XYZ company at 800 rupees, Y company at 20 rupees. Okay, and unlike a T20 game, you don't have to do anything about it. Because it doesn't make sense to you, you don't have to do anything about it. In T20, you're forced to hit it out every ball, otherwise they'll call you a bum and get you out of the game. But the game of investing is one where you can take your time. You can just watch the ball. Then occasionally, like in cricket, there'll be a ball outside the off stump, which is a full toss, which you know you can hit for a 6. And that's what you want to wait for, with the big fat pitch outside the off stump. Investing is very similar. You want to wait for the big fat pitch outside the off stump, which you can hit out for a 6. So a lot of professions prefer activity, but the key to the stock market sometimes is just sitting on your rear. And it might take 6 months, 8 months, 9 months for the big fat pitch to come. But when it comes, you need to move right away. Then you can't wait. Okay, so you need to keep your cash ready, keep your mental acuity ready, and keep thinking about what I'm going to buy for when that happens. So I think Warren Buffett showed when he bought Coke or when he bought Apple, it's never really too late or too early to buy a particular stock. He bought Coke after it was listed for 125 years. So he waited 125 years to buy it. Apple is a well-known stock when he bought it. He still made up enormous amounts of money in those things. So because he waited for the right pitch, the right circumstances, but when it came, he moved decisively and put big amounts of money in there. So I think those are just some of the things that are important to remember.
That's a very interesting point. In my personal investment journey, what I felt that, to use a cricket analogy very well, that I will take single very easily. I will take single, and then there will be loose ball and I will lose my wicket. In the next match, if there's a dive full toss also, I'm playing single. So how to deal with this emotional loss? Because my financial loss you will, but once you have emotional loss, you try to lose that appetite to make that risk.
Great question. I think that's, as I've often said, that to me, there's nothing sadder than someone making 20 points when you could make 20x's money.
Correct.
And typically the way to think about that, the way to be a long-term player, is to understand that there are bull markets and bear markets. And typically at the end of a bear market, there are astonishing bargains available. When you have limited amount of cash, a lot of less courage, less conviction, but the enormous bargains available. So if you can buy the leadership, what do you think the leadership of that bull market is going to be in the next year, in the next years? I think you end up making a lot of money. And then if you do your homework, you're a CA, for example, so you can do the homework. For example, you could think, that India is going to be the diabetes capital of the world.
Correct.
Okay, 1 in 10 Indians suffer diabetes. Now, once you figure that out, then you know which medicines are working, which doctors are working, which exercise clinics are working, which insulin pump is working. So you can say that, just because if everyone in India is going to go to an insulin pump or an Ozempic or whatever have you, the population in India is, it's 150 million people going to get diabetes. Okay, if the 150 million people, 75 million are going to use pumps, you know the size of the market is. So just because the stock goes up 20 points, you're not going to sell that. So I think once you do the math and then you learn the patience to hold it, true wealth is built through long-term compounding. So I think once you do the math and manage to hold on to a few stocks, your life will change, and I think you'll be able to do that much better. So it's always getting the first one right, and after that, it becomes a way of thinking.
In this, there's a very bad theory that when we should exit, because you can stay in this company for long term, but then there will be a time that the company will not do great, and at that point of time, a lot of investors try to exit. How do you know that this is the time to exit from that particular stock?
It's not easy. It's hard.
Sorry to interrupt. Like for example, Apple. Like Apple in 1982, 1980s, you would have 84. I think you listed, and then you would have invested. You have made great amount of money till that time. John Scully came from PepsiCo, Coca-Cola, and then it collapsed. Now that journey, people will have thought for 10 years, then you don't know when to exit.
Yeah, there are no shortcuts. Making money is hard. So you know that. You work pretty hard to make your money as a living. So there's no God-given right that you should make 10x, 20x, 50x, 100x in a portfolio. So obviously you're going to face these challenges. So it comes down to your understanding of the business. Here are the things that I would tell you, the shortcuts that I use. Why would I sell a stock? If I find a better alternative to put in, if I find my capital is better utilized elsewhere, I would sell A to buy B. All right. But the one that I use more importantly is that I try to time market cycles, bull markets and bear markets. Typically, if you're in the market signals to you when a bull market is getting over. Now, if you believe that's getting over, then you want to get into cash, at least some cash. Because you know in a bearish phase, everything's going to be down 30%, 50%, 70%. So might as well get some cash out of that. But we try, I'm not saying it's successful, we try and hold a business for long periods of time because we know that's where the true wealth is made. But it's not easy. But typically you would try and time the cycle, try and figure out when does the bull market get over, when people are leveraged, when people are talking nonsense, when earnings don't justify the valuations that the business is getting. So there are a whole host of issues too small to go into a podcast. But if you spend enough time at it, I think the market speaks to you. That's one of the things of the market, that it never happens in absentia. Markets will always signal to you through technical reasons, the moving averages, the breadth of the market, the leverage in the market, the public opinion in the market, when the market feels heavy. So I think I would use some of those.
So this, you said, bear market and bull market. Now what we as a financial expert are seeing that these two markets are happening at the same time in the same economy. Do you also feel the same, that some sectors are doing very well, some sectors are doing very bad? So
Not really. Bull markets typically is a rising tide which lifts all ships. Some ships are lifted more. So in a various bull market, you will have some sectors that are hugely outperforming sectors. For example, AI in America is now outperforming. Yes. Defense in India is outperforming. If you're a good analyst, you want to try and catch what the sector is leading the bull market, because that will give you the maximum gain. For example, in 92, what led the Indian bull market? It was the cement stocks that led the Indian bull market. Then 2000 was the technology stocks. In 2008 was the consumer stocks. In 2018-19 was the PSU stocks. So if you can identify those bull market leaders, you tend to make the maximum amount of money. You'll make money in the other stocks also, because the rising tide lifts all boats.
Correct, yes.
But it's much easier to get the leadership right.
Because right now, if you look at the US market, so I am much more concentrated on US market being a global audience, that if you see the US market seems to be on a bull, but if you remove the top 7 companies, Apple, Amazon, Facebook, Meta, Google, then the stock market has not performed. In this case, sometimes those few heavyweights try to tend the market upside. How do you respond in this market?
See, that's true. What you're saying is right. There's been unusual degree of concentration in America because of AI. But there are other sectors that are doing well. Data centers, power, nuclear energy. Other than those magnificent 7 stocks, it is percolating down slowly to the other levels of the stock market. It is a bit scary to see all the value unlocking in the 7 stocks out there. But I think you look hard enough, you will find, other stocks also doing well. Probably not as many as you would like to see, but probably see them.
As an investor, what I'm reading the market, what my understanding is today, equity market is not that much of a value creator. My assertion come from that I think previously the private equity or venture capital will start early into investing in the company and will do the IPO. In today's market, the private equity remains still like Series A, B, D, C. So for retail investor or to a lot of investors, there is no value unlocking. Do you also feel the same, that today's market is very difficult to make that 100x, so that okay, my grandfather left the share?
I don't actually. I'll tell you why. You could have bought Nvidia in 2010 and you could have made 1,000x your money. Yeah. You could have bought Facebook, you could have bought Google. They all have been 50 to 100 baggers in the last few years. So there are opportunities almost every day in the stock market. Okay. Believe me, you could buy 10 stocks today and at least 1 or 2 will be a 50, 100 bagger in the next 10 years or so. So I don't believe that. I think market has its own process of price discovery and value discovery. The rewards go to people with insight who understand what a particular trend is going to be and how it's going to play out. I think 5 years ago, no one had heard of Nvidia. And suddenly it's now reporting a quarter of $65 billion worth of sales. So there are always companies that will stand out, and it is your job as an analyst to figure out the job. Again, I want to repeat this point that I make. It's not easy to make money. There's no formula. If everyone had a formula, the librarians or the mathematicians would be the richest people in the world. It's not easy. Of course, it's not easy. It can't be easy. It cannot be, you do these 3 things, you get it right. Sometimes various things work. It is a job as an analyst to figure out all that stuff. And if you want to be, in that hallowed circle of being a multimillionaire or being a someone on $100 million, you'll have to give a lot of time, effort to it. It's not an easy thing. It's a full-time profession. So I'm just trying to think that don't think it's down to 3 things in life. It's not. The whole bunch of things, and then you hope to get it right.
My question comes basically from, I think, Lenskart, Zomato, which are operating, which are getting IPO'd at 200 times profit earning. Somehow the retail investor will feel that, okay, there is no value unlocking left for him. Already the market has, the previous investors have taken all the gains out of it.
I think they're making a mistake because you have to remember digital economy is a very scalable business. They have 10 million customers, go to 20 million, 50 million, 100 million. It's so easily scalable without the proportionate return of infrastructure spent.
Correct.
So the return on capital, the cash flows will be very substantial over the next few years. So, is there money left on the table? Zomato had gone down to 50 rupees. Now it's back to 300 rupees, just to give you an example. I'm not recommending it in any way. But to give you an example of a stock out there. So, you'll always find that people get depressed or throw away those things. That is what I'm saying. You have to wait for the fat pitch outside the off stump so you can hit for a 6. So when Zomato came down to a particular level, maybe it was a fat pitch looking that you should hit outside. It is your understanding the digital economy, your understanding the economics of the business. Very interesting example.
Similarly with Paytm also. Paytm also went down and then came up.
So many of them. Narayan Murthy was addressing a conference and he said it took him to come to Bombay airport to a Hyatt hotel where the conference was being held. It said it took me an hour to make normally a 10-minute journey. And he said, look at the audacity of people like Zomato, Swiggy and the like, who are saying that we will deliver your groceries to you anywhere in Bombay for 12 minutes. He said, whether they can do it or not, I don't really care. But even that they are so audacious enough to promise that means something to them. And that is a very good way to think about it. That these guys are so audacious, they want to change the way we live, they change the way we consume goods. You have to respect that. I think markets over time will realize that the network they've created is almost irreplaceable.
It's a totally disruptive business. My next question, in many of your interviews, I see that you quote Mr. Munger a lot. And he has a very famous book, Poor Almanac, with
Poor Charlie's
Almanac, and he talks of mental models. So any of the mental model which you use of Mr. Charlie Munger and which we can also learn from?
No, Charlie Munger is a great teacher. I think Warren Buffett himself said when Charlie passed away, he said that he was the architect of Berkshire Hathaway and Buffett himself was the general contractor. That is the graciousness of Buffett, but Munger has a huge contribution to make. There's so many mental models, but things that we always use is something called margin of safety. For example, he often said that if you build a bridge that is going to take, 200-pound trucks, you have to build it for 500 pounds because you don't know when a 500-pound truck is.
Okay, yes.
So margin of safety is buying things cheap. It's like अपनी माँ ने हमको सिखाया था सामान खरीदने की रुपये की चीज़ 28 में चाहिए अपने रुपये की चीज़ 54 में चाहिए अपने को सस्ती चाहिए. You want to buy things cheap out there.
Correct.
That's when you get the true margin of safety. That and the other thing that I learned through various people, including people like Chandrakant Sampath, Warren Buffett, and Charlie Munger, was compounding. Compounding is what truly makes wealth in the stock market. So if you can even compound something at 20% over a 30, 40, 50-year period, that initial investment I told you becomes...
Yeah, you mentioned about
Berkshire itself, becomes a huge amount at the end. So if you go back and look and study the Indian companies, so many businesses have grown at only 12, 15%. But if you held them for 30, 40 years, you become very rich through the process. It's very hard to grow consistently at over 15, 16%. So if you can ever find a franchise that's growing at 20%, 23%, that's worth its weight in gold. So, the Munger's lessons there's so many, I can't even begin to describe them. But just to read him, to understand him, I think would be a great starting point for a young person.
Thank you. There is one important thing that there are a lot of equity investment expert in the market. What do you think what was your differentiation which made you Ramesh Damani?
You're very kind. I think I read a lot and I think that helped me because I'll give you an interesting story. When I came back to India from America, like I said, in 87, 88 sometime, at that time I got used to reading the Wall Street Journal in America. And there was no copy out here, Wall Street Journal. Finally, I found a vendor who said he'd get me a copy of it. And he started delivering me a copy of the Wall Street Journal and the International Herald Tribune as the New York Times was called at that time. Huh?
In Mumbai?
In Mumbai, he started doing that. One ideal day, he happened to deliver it to my office. So I was sitting and talking to him. I said, how many copies of the Wall Street Journal are you delivering every day? And he said there were only 3 copies that were delivered to Ratan Tata's office, to the chairman of State Bank of India, and to Ramesh Damani out there. So when I tell you how it helped me, in 89-90, I was reading the Wall Street Journal regularly. And for the first time, I saw an Indian company quoted in the Wall Street Journal. And I was shocked because the Wall Street Journal didn't cover Indian companies at that time. Because India had a closed market, so there's no use for international investors. So I remember reading about it and pointing out to my friend, who got also very excited when I told him about that. And then we went and invested in that company, and that company became one of the great companies out of India. The name, if you're not figured it out by now, is Infosys.
Infosys. I thought Patni Computers. Infosys.
Which one did you think?
Patni Computers.
No, Patni Computers, of course, came listed much later. But Infosys was developing a chip which ultimately failed. But because it was covered in the Wall Street Journal, I thought, maybe it's a very special company. And it was, for that matter. And the stock became the bulwark of my first portfolio bet. Yeah. So that was my fat pitch outside the off stop that really helped me.
And sometimes that gives the confidence later on to make those particular.
Also, you remember, just see how life connects. Remember in my 80s, I worked as a techie. So when the software business came in India, I kind of was the first people to understand the business of intellectual property, the investment, that don't invest in plant machinery, asset-light models, free cash flow, not influenced by oil prices going up.
Correct.
So that was my big break. So, you have to keep looking and you'll find something within your circle of competence.
And Indians tend to majorly invest into trust or reputation rather than the underlying sources.
That also, but there was a whole generation of investors that didn't understand technology. They got to understand it 5-10 years later. But if you were the first, you ended up buying their stocks really, as your mother said, rupee ki cheez 10 paise mein, 5 paise mein, 2 paise mein, which was my lucky break.
Thank you, Mr. Damani. I think as we will have the conference, I wanted to ask about any advice you have for young chartered accountants or any senior chartered accountant which we can do and try to actually generate that 20% CAGR.
I think the read, of course, that's I go without saying. But I think a lot of people like you at a conference will come and ask me, they said, oh, you were lucky. You got to India in 1990 and the index moved and you made your money out there. What are you going to do now? And I've often said this, that I also do a podcast, I also do a show. So I happen to meet some of the best investors in India and across the world. And often when I ask them, what has been the best decade to invest in India? Has it been the 1990s when India liberalized for the first time? Has it been 2000 when India became a tech superpower? Or was it 2014 when Narendra Modi became Prime Minister of India? And almost unanimously, to the man, they say the best decade to invest in India is the next decade to invest in India. So, I think there's no need to get...
You say it before the demographic dividend, or is there any underlying to say that?
I think there are a lot of reasons that will take place. I think the Indian bull market is, still truly underway. There'll be what I call the 3Ds, again, which I'll talk about in the conference, democracy, digitization, and democracy, which are propelling this country higher. There's huge amount of liquidity coming in on a sustained basis in India. So I think my belief is that जैसे कहावत है जब जागो जब सवेरा. So you haven't invested in the last 25 years, you're feeling left out. Don't feel too left out. There's still a chance. So you don't want to feel left out 10 years from now.
So, but we should tend to stay in like index funds or ETF or direct stock. What is the method? Well,
that's a more complicated question. I think if you don't have time, if you're a CA and you're busy, you don't have time, and you still want exposure, then I would recommend the index fund for people. So if the index goes at 10-12% CAGR, you go at 10-12% CAGR. That's what I would say. But the way to wealth in the stock market is through buying individual NVIDIAs and Apples and Infosys and Reliances of the world, okay? So you need to find individual stocks. I mean, that's my passion, capital allocation, my passion. I think you need to do that if you truly want to find a stock that goes 100x, 200x, because the index is not going to replicate that performance. So if you are passionate with the stock market, I would urge you to do single stock, figure out what you want to buy. If you don't have the time, you're busy in your own profession, raising your kids, taking care of your house, whatever, there's lots of reasons, then the next best alternative is to put it in an index fund.
Thank you, Mr. Damani. I think so that was amazing. I think this interview seems like an NVIDIA to me in 2019. Will give me hundreds of return in a few years. Thank you again for your time.
That is so sweet of you, Vinit. Thank you so much for having me.
Thank you.
Bye.
Bye.